this topic is, but the fact that so many of you are here today obviously reflects the fact that you are all well aware of that. So let me just say welcome and turn it over to John Samuels.
Thank you and good afternoon. I'd like to add my welcome to Alan Biards. I am not a resident scholar anywhere. I'm John Samuels, the head of tax at GE. But today I'm here in my capacity as chairman of the International Tax Policy Forum, not as the head of tax at GE. Now, the Independent Tax Policy Forum is a group of more than 40 major U.S. multinationals, and we are really pleased to be co-sponsoring this conference with AEI today. I think we've got a terrific program, and I'd like to thank Alan and AEI for helping to make it possible. And I know you're all familiar with AEI and the important role it plays in fostering research and dialogue on important issues of public policy, like the ones we'll talk about today. And hopefully by now you're familiar with the ITPF, because in addition to sponsoring academic research, we have been sponsoring conferences like this one for the last 20 years. But just in case some of you are not familiar with the ITPF, I am, as I always do, going to take a few minutes to tell you what we are and what we're about, and the best way to do that, as I always start, is by telling you what the ITPF isn't. Even though we're a group of 45 now major U.S. multinationals, we are not a lobbying group. We do not have an agenda for particular legislative changes, either particular or general. We don't lobby for any legislative positions. Indeed, I doubt that, in fact, I'm pretty sure we couldn't reach a consensus among our members on any particular set of legislative proposals. Instead, what the ITPF represents is a unique intersection between business, the academic community, and government policymakers. We organized the IPF in 1992, some 20 years ago, with the principal mission of sponsoring independent academic research in the international tax area. And I'm happy to say we're going to be celebrating our 20th birthday tonight at our meeting. There, you'll see some, those of you who will be there will see a nice pamphlet that we've prepared. Now, our goal 20 years ago was to develop a body of objective and independent economic research on how tax policy affects international capital flows and cross-border investments that hopefully would help policymakers make even more informed decisions about the design of the U.S. international tax system. Now today, under the guidance of Jim Hines, who is the ITPF's Director of Tax Policy Research, we're supporting a wide variety of research projects undertaken by leading academic economists in areas of international tax that are of interest to them. And our research program is overseen by our distinguished and independent board of directors, who, in addition to Jim Hines of the University of Michigan, includes Alan Auerbach of Berkeley, Mihir Desai of Harvard, Michael Gratz of Columbia, Matt Slaughter of Dartmouth, and Michael Devereaux of Oxford University. We are really very fortunate to have this enormously talented group of leading academic thinkers to help guide our research program. And I want to be clear, as I always am, on a very important point. It is the stated policy and practice of the ITPF not to attempt to control or influence the subject matter or the conclusions of this research in any way. Indeed, I think it should go without saying academics of this caliber simply wouldn't let that happen. Now, we've sponsored many conferences over the years on important issues of international tax policy, ranging from the effects of foreign direct investment on the domestic economy to locating the source of taxable income in the global economy. Now, these conferences have spawned more than 30 academic papers, papers that hopefully have advanced the state of our knowledge and have contributed to a more rational and informed debate about international tax policy. Now today we're going to be discussing another important development in international tax policy, the very significant and fundamental corporate reforms, tax reforms that have recently been adopted by the UK, one of the world's largest economies and one of our largest trading partners. Now just consider this. In the last few years, the UK has reduced its corporate tax rate to 24%, with a further reduction scheduled to 22% to take effect in 2014. It has abandoned its worldwide system of taxation in favor of a territorial system that exempts 100% of a UK company's active foreign income from UK tax. And it has significantly increased incentives for research and development performed in the UK, including adopting a patent box regime that will reduce the tax rate on income from qualified patents to only 10%. And while the UK has also at the same time adopted a new CFC regime designed to protect its tax base by preventing the artificial diversion of profits from the UK, at the same time it has been very careful to make sure that these new CFC rules won't prevent UK companies from reducing their foreign taxes so that UK companies will be able to compete more effectively in foreign markets. And the UK has made no secret of its objective or why it's making these fundamental changes. And here let me quote some of the reasons given by the UK government for reforming their tax system. And these are direct quotes. The government wants to send out the signal loud and clear that Britain is open for business. Our aim is to create the most competitive corporate tax regime in the G20. The government believes the corporate tax system can and should be an asset for the UK, helping to attract multinational businesses and investment to support the UK economy, and encouraging companies to locate the high-value jobs associated with the development, manufacture, and exploitation of patents in the UK. And very importantly, I think we need to recognize the UK is not some small island in the Caribbean with little to offer other than warm weather, nice beaches, and low tax rates. Quite to the contrary, the UK is a highly developed country. Some of the beaches are nice, David told me. But quite to the contrary, the UK is a highly developed country with a stable and democratic government, a well-established rule of law, and it offers world-class infrastructure, a skilled labor force, and major universities and research centers. And all of these factors make investing in the UK attractive even without the pull of an attractive tax regime. But on the margin, when you add these additional tax incentives, the UK's new tax reforms are going to be even more powerful in attracting global headquarters and inbound investment. And simply put, it's one thing to move your headquarters or a big operation to the Cayman Islands, kind of often hard to do. When you're moving into a developed country like the UK, there's a lot less non-tax friction. So in some sense, the stakes have really changed. Now, of course, the UK is not alone. It should come as no surprise to anyone in this room that in today's fiercely competitive global economy, many countries are openly, aggressively, and unapologetically using tax policy as a powerful tool to attract foreign investment, corporate headquarters, and jobs. Now, some in this room refer to this global tax competition for investment and jobs as a race to the bottom, which I guess it is if you define the goal of the race as being how much tax revenue a country can collect by taxing internationally mobile capital at the corporate level. But what if a country's goal in the race is not to raise as much revenue as possible from taxing highly mobile capital, which it may consider to be a fool's errand in today's global economy, where capital can and does flow across national borders like liquid mercury? What if instead a country's goal is to design a tax system that will attract global headquarters and new foreign investments that will result in high-paying jobs and other spillover effects that will increase the standard of living for its citizens and residents? Then maybe it's not a race to the bottom at all. Instead, maybe it's a race to the top. But whatever you think about this race, whether you think it's about a race to the bottom or a race to the top, and whether you like it or don't like it, the fact is it is a reality in today's competitive global economy. And the race is not only underway, but it's gathering steam. And there are no signs it's slowing down. Which begs the question, what can or should the United States do about this proliferating global tax competition? How should we respond to this new reality? Now, can the U.S. afford to sit in the grandstands and watch as the race unfolds? Now, that's been our penchant in the past in responding to tax competition from other countries. Or should the U.S. somehow respond to this accelerating global tax competition? What some have described as the breakup of the tax cartel that has existed for so many years among the world's largest and most developed economies. The cartel is breaking and maybe broken. And, this is a fundamental, timely, and extremely important question that demands and deserves full, rigorous, open, and transparent discussion and debate. And it's particularly true now as U.S. policymakers are on the brink of considering fundamental tax reforms here in the U.S. Now, hopefully this conference will serve as a constructive step in shedding some light on this very important question. Because in addition to being very fortunate in having David Gauke, the Exchequer Secretary of the UK Treasury here with us today, and David was one of the driving forces behind the UK tax reforms, we also have a blue ribbon cast of participants to help us address these important questions of tax and economic policy. Now, it will be surprising if all of the participants in today's conference find themselves in complete agreement. I'm quite sure several of today's presenters or discussants will disagree and will engender some lively and hopefully enlightening discussion. And in this spirit, I encourage our large and well-informed audience to please join in the discussion today. I explained to David this would be a smaller audience, but a very focused, potent, and influential one. It's a much bigger audience than I thought, but I know you are all very involved in the tax policy process and interested in it here in the United States. So please participate, and remember, where there's heat, there's sometimes light. So finally, I'd like to express some appreciation my appreciation to Alan Viard and AEI for helping to make this conference possible, and to Peter Merrill and Marjorie Sweat of Price Waterhouse, who are instrumental in making this conference work. Now, I want to turn the program over to my colleague and partner, Will Morris, who will introduce our first speaker, David Gauke, the Exchequer of the UK Treasury. So thank you all for coming, and I look forward to an interesting dialogue.
Thank you. It's sort of musical labels up here, but it's my great pleasure to introduce David Gauke, who, as John said, is the Exchequer Secretary to the Treasury. In that sort of great British tradition, it feels like this must be a title which dates back centuries, maybe even millennia, but actually, without in any way wishing to disappoint you, it doesn't. However, it does hide a very important fact, which is that David is, to all extents and purposes, the tax minister. But in US terms, that doesn't quite get over what the job does, because you think, well, maybe that means he's the assistant secretary. Well, he is sort of the assistant secretary, but actually he's also sort of the chairman of the Ways and Means Committee. And one of the great advantages in the UK system is that first you get to decide what the policy is, and then if you're in the government, you get to ram it through the parliament as well. So David actually helps formulate the tax policy, then stands up in the House of Commons and defends it, and then gets to have it enacted and to have people write the regulations which deal with it. So if you assume that David is simply part of a check and a balance, you'd be wrong unless he's both check and balance. But working with David has been a great experience. As John said, I'm also from GE, but I have the great privilege of being the chair of the tax committee of the CBI, which is an unusual position for somebody who is essentially a US attorney rather than an English lawyer, but that's what they wanted. And in that position, I've had a huge amount of opportunity to work with David and also with the great officials that he's brought with him today on a number of very important projects. And I have been incredibly impressed at every turn at how much the government has listened, how serious the consultation is, how much business input has not just been solicited, but then actually acted on as well, and not in a way that means that business gets everything that it wants, not in a way where the government rolls over and forks out large amounts of money, but in a way which makes the tax system work for both the government and for business. It's not a confrontational proposition. Actually, it's about how do you make the economy work and how do you build it up. And David has set the tone in that. and it has been a great experience. Some of David's bio is in there. I want you also to know, however, that for those of you who are fans of Masterpiece Theatre and assume that the English cabinet must be made up of people who either went to Eton or Harrow, there is some truth in that. But David is about as close as we get in the UK to a log cabin conservative, having come up the hard way, having won a place at Oxford, having actually worked in the real world, well, a law firm, but sort of the real world, and then been elected to Parliament in 2005. David is a truly interested leader and participant in this. He's not just interested in getting to the right results, but actually in the way the policy is made as well. So with that, David is going to speak for several minutes, and we're then going to take a few Q&As in this section, and then David will be part of the panel that comes next as well. But it gives me great pleasure to introduce David Gauke, the Exchequer Secretary to the Treasury.
Well, thank you, Will, for that very kind introduction. I've never been described as a log cabin conservative before, but Will is right to say that I do have the title of Exchequer Secretary to the Treasury. He mentioned briefly its history. I did decide to research this grand title. And to be fair, I did discover it goes all the way back to the mid-1990s. You will also have noted that I'm not the only British minister in the US this week. The Prime Minister has also been here. And I'm afraid, well, I was delighted when we drew straws that I got to do the ITPF and he got to do Letterman. On election in 2010, the UK government faced some very significant challenges, to say the least. Of course, we were not by any means alone. Many of those issues were faced worldwide, and many of the problems shared with the US. High levels of private debt, which had fueled a housing boom, high levels of public debt, which had grown rapidly and significantly as a result of the downturn of 2008, and a rapid decline in financial services, which had formed such a significant part of our economy, leaving a major gap. But in some respects, our differences with the US made that situation even worse. Our economy is smaller and less diverse. Financial services constituted 10% of our economy, and based on industry figures, over 12% of tax revenues. The balance sheet of UK banks were worth more than 5 times our GDP. Our economy was more concentrated geographically. London was responsible for 1/5 of UK economic output, and several parts of the country had become increasingly reliant on public spending from the tax revenues that it generated. And of course, there is our location, geographically, politically, and economically, in Europe, which continues to suffer from possibly the largest scale currency and sovereign debt crisis in history. Almost half of UK exports go to the rest of Europe, and so the uncertainty and decline in Europe's fortunes created a further drag on the demand side of our economy. And the panic that has been created as a result of a sovereign debt crisis that started in Greece and threatened to creep across Europe, as it still does, created a new imperative to reduce the deficit as well as sustaining growth. The property boom and unsustainable profits and remuneration in the financial sector in the pre-crisis years had driven rapid growth in tax receipts. As tax receipts fell away during the crisis, the public sector was revealed to be living beyond its means. When we came to office, the UK was forecast to have the highest deficit in the G20, and the economy was expected to be more than 10% smaller by 2016 than expected before the crisis. In that context, it was clear that strong and decisive action was necessary. 2 parties in the United Kingdom, the Conservatives and the Liberal Democrats, came together to form the first British coalition government since the Second World War to address these historic challenges. The scale of the problem demanded large-scale reform of the UK's economy and finances. Fiscal consolidation to restore the public finances to a sustainable path, monetary activism to support the recovery and increase the availability of credit, financial sector reform to increase resilience and reduce risks, structural supply-side reforms to promote sustainable growth across a wide range of sectors and regions, and to tax reform to improve our competitiveness, reduce distortions, and promote private sector enterprise and growth. Now, today I'd like to talk particularly about the last of those, what we chose to do and why, the effects that our actions are having, and the actions I believe we should take in the future. The ambitious programme we embarked upon needed to tackle both the major problems we faced, large and unsustainable public debt, and a troubled economy built on shaky foundations. Despite the size of the shock in the UK, which experienced a bigger shock and has a lower capacity to sustain debt than the US, there were many who argued, and still do argue, that our two goals were incompatible, that it would be impossible to make the reductions to public spending that we thought necessary to return sustainability to the UK finances, whilst at the same time promoting growth. Often there is indeed a tension, not least in the area of tax. At a time when we needed to plug big gaps in the nation's finances, it might have seemed like an easy path to take to ramp up taxes on popular targets. But that was a temptation that in our case needed to be resisted. The picture was much more sophisticated than a simple growth or cuts narrative that some might have wished to paint. That's particularly true when it comes to tax policy. The success and efficiency of an economy is not only dependent on the overall level of the tax burden. Looking at how tax is raised is often much more important than considering just the absolute amount levied. We must consider the base on which the tax is charged, the structure of that tax, the design of it, the certainty around it, and the way it interacts with other taxes, wider government policy, and the wider economy. The art of tax policy is a fine and subtle one. It needs to be treated carefully, and the right thing to do is not always the most popular. This takes me to one of the great challenges of tax policy making. By and large, the most economically damaging taxes are very often the most popular taxes, or perhaps I should say least unpopular taxes. This is because the public tend to be less concerned about those taxes that they perceive are being paid by someone else. Now, this includes corporation tax. Now, there are those who advocate taxing big business more as if the burden will fall on some remote and impersonal organisation. Of course, all taxes are paid by individuals in the end, and the burden of corporation tax will fall on a combination of shareholders, employees, and consumers. For a relatively small, open economy like the UK, the academic research points to employees bearing much of the incidence. The reason for this is that corporation tax reduces the return on capital, which in turn reduces investment, and that can flow elsewhere. The reduction in investment reduces productivity gains, and that will feed through to salaries. Now, our view is that uncompetitive levels of corporation tax result in economic distortions, inefficiency, and a barrier to growth. And from our first budget, we made a significant conscious policy choice to address this by rebalancing the tax system away from taxes on capital and towards taxes on consumption, reducing corporation tax even in a context when taxes have increased, altering the tax mix in a way that will mean an overall gain for the economy as we remove disincentives to invest. That view is shared by a wide economic consensus, including the Office of Budget Responsibility. This is an independent body we set up as soon as we came into government in 2010 to produce credible and independent fiscal and economic forecasts, fulfilling many of the same functions as the Congressional Budget Office and Joint Committee on Taxation here in the US. The OBR forecast indicates that investment is likely to increase as a result of the government's policy to reduce corporation tax, which will help our economy to grow. Now, to say that cutting taxes can help the economy is perhaps uncontroversial, but it does not come for free. Other taxes need to rise, or spending cuts need to be made, or borrowing must go up. So as well as working towards nearly 80% of our planned consolidation through spending reductions as opposed to tax rises, around a 3% real terms cut across the board, we have looked to raise more efficient taxes on wider bases that are less easily distorted, particularly on consumption. In 2010, we increased value-added tax from 17.5% to 20%, more in line with prevailing European averages. VAT is a more efficient tax. Taxes on consumption are less damaging than taxes on profit or employment. And the structure of the UK VAT system, which excludes most food items, means that the tax does not have the regressive impact that some have suggested. But it is a very visible tax, and of course, lots of people pay it. The decision to raise VAT was not an easy choice, but was necessary in light of the fiscal challenges we faced. Sometimes we need to take something of a political hit in order for the economy to gain in the long run. Now, efficiency is the big part of the story, and perhaps the main reason we chose to pursue the path we did. But there is a wider context that makes corporation tax reform and wider reforms to our tax system all the more imperative. In an increasingly globalised world, with freely moving labour and capital, it is vital for the UK's interests that an open economy like the UK can attract the investment it needs from abroad. We had to reverse the steady decline in UK competitiveness that had scarred the last decade. In 1997, the UK had the 10th lowest main rate of corporation tax in the EU. By the time we came to office, it was the 20th. The UK's tax regime had lost its competitiveness, and this was causing some businesses to leave the UK. The main focus of my remarks today is with regard to corporation tax, but the point can equally be made with regard to income tax. In 1988, our top rate was reduced to 40%, one of the most competitive rates in the world, below the OECD average. That rate remained in place under the last Labour government, at least for 4,722 days of their 4,758 days in power. But by the time we came in, we inherited a rate of 50%, one of the highest rates in the developed world. It discouraged talented individuals working in the UK, raised little, if anything, in additional revenue, and sent a signal that Britain was not open for business. As of next April, that rate will be reduced to 45%. That will put the UK's statutory top rate below that of Australia, Canada, Germany, or Japan. But taken as a whole, our objective for the UK tax system is both clear and ambitious. We want to establish the most competitive tax system in the G20 to support enterprise and attract new business. Our tax system was once viewed as an asset, and that's the perception that we want to restore. I hope that the action we have taken with respect to corporation tax will help to achieve that. We have already cut tax from 28% to 24%, as you've heard, and in 2 years' time it will be 22%, within sight of 20%. By 2014, the UK will have the lowest corporation tax rate in the G7 and the fourth lowest in the G20. But as I said, a strong and competitive tax system is not just about cutting rates. It's about making sure that the whole tax system is structured and tax policy made, administered and enforced in a way that is friendly to business and friendly to growth. It means offering businesses the stability and certainty they need to make long-term investment decisions and to feel safe and certain doing business in our country. So we have both committed to tax changes and are making sure that businesses are informed of those changes well in advance. We took the unprecedented step of setting out our plans for corporate tax policy over the next 5 years and have brought forward the publication of tax legislation so that the public, business and advisors have months rather than weeks to scrutinise it before it's taken through Parliament. It means ensuring the tax system is as simple, straightforward and easy to understand as possible. So we've established an Office of Tax Simplification to provide independent advice on simplifying the tax system, which has already published recommendations to improve small business tax, share schemes and tax reliefs, most of which we are now adopting. It means close and extensive consultation with business and other stakeholders, while genuinely paying attention, taking note and adapting policy accordingly. And it means looking at how we can tailor specific innovative tax proposals to offer the incentives and rewards needed to make the UK competitive in the modern global world. Let me talk about a couple of examples: introducing a new patent box and our reform of the controlled foreign companies regime. In recent years, businesses have become increasingly focused on creating and exploiting intangible assets. Multinational groups have a choice over where they locate work generating scientific and high-tech IP, and where the patents are held. So it has been crucial to ensure that our tax system remains competitive for innovative businesses, particularly as many of our European neighbours, France, Belgium, the Netherlands, to name but a few, already have a patent box or similar scheme in place. So we introduced a scheme to apply a reduced rate of 10% corporation tax on profits from patents, encouraging innovative businesses to invest in the UK and locate high-value jobs and activity there. And in addition, we are increasing the support to business through R&D credits that encourage expenditure on research and development. New innovations in research and development generate enormous benefits that spill over well beyond the companies that develop them. Just taking a look at some of the major innovations over the last decade confirms this. Advanced touchscreen technology, hybrid cars, the ability to grow human organs for implant from scratch. Firms reinvesting in R&D cannot capture all the benefits that accrue from their investment, and so it falls to government to promote the right level of investment, as well as to ensure that we continue to be world leaders in patented technologies. The UK has also needed to ensure that its tax base rests on profits from domestic activities rather than income that is earned overseas, and that profits are not artificially diverted from the UK. That means an open economy like the UK has needed to move towards a more territorial system of taxation, taxing the income earned in the UK, but not elsewhere. Reforming the taxation of foreign branches of UK companies by introducing an opt-in exemption from corporate tax levels the playing field with the taxation of overseas subsidiaries. And we've modernised the UK's controlled foreign company rules that protect against the artificial diversion of profits to low-tax jurisdictions to reflect better the way businesses operate in a globalised economy. The CFC reforms have been described as a watershed moment. The UK is changing the basis on which it taxes overseas profits, with a focus on taxing profits from UK activities, striking the right balance between making the corporate tax system more competitive and providing adequate protection of the UK tax base. CFC reform has stemmed the flow of businesses leaving the UK and has encouraged businesses to return to the UK, such as WPP, which left only a few years ago because of the adverse corporation tax environment, while others have recently announced that they are considering moving to the UK. And finally, the UK has played a leading role in improving tax administration, easing burdens on business while maintaining a strong response to tax avoidance and other risks. Her Majesty's Revenue and Customs take a direct approach to engaging with large businesses, pursuing open and transparent working relationships. The complexity of these cases and the amounts involved often make this the most cost-effective way to improve tax compliance, while at the same time supporting business. For the largest 2,000 corporations in the UK, we have a dedicated customer relationship managers to ensure both support for the businesses they handle and ensure rigorous compliance. This strategy has been very successful, producing positive business feedback from business, while also helping HMRC to maximise revenues by recovering the right amount of tax. For example, HMRC has tackled the most serious avoidance cases amongst large businesses through dedicated task forces, enabling them to resolve over 1,800 outstanding tax issues and bringing in an additional revenue of nearly £16 billion since this approach was established. This use of intensive relationship management tailored to risks has been endorsed by the OECD in its recommended approach to aggressive tax planning and is increasingly being followed by tax administrations around the world. These are the steps that the UK has taken, and the results have been welcome. Ernst & Young described our tax regime as close to best in class, while Deloitte suggested that our tax regime is the most competitive in Europe among normal countries. Their words, not mine. More than a million private sector jobs have been created since we came to power in 2010, and the World Economic Forum this year placed the UK 8th for overall competitiveness, up from 10th last year. For the first time in over a decade, we've been exporting more to the rest of the world than to the European Union. Now, these are not sermons or prescriptions. Our economies, while closely intertwined, and with much in common, have fundamental differences. There's much that we can learn from each other, but each country has its own position and challenges, and the US in particular, with its global dominance and a reserve currency, is in a unique position. But I do hope that I've been able to show you that the commitment that we have to addressing the challenges that we face and to making the UK an excellent place to do business for countries across the world. The UK has a lot going for it. A central position between time zones, a liberal open economy, a sensible, welcoming approach to foreign business and investment, a position as a gateway to Europe, and some really lovely beaches. The approach we are, if not warm, the approach we are taking is strengthening that position still further and making the most of the considerable assets we have. The last few years have been challenging for most Western economies, ourselves not excluded. And over the decades ahead, the long-term challenges are considerable in terms of responding to the emerging economies and maintaining competitiveness. Some countries will succeed in meeting those challenges, but others will fail. The UK government, however, is determined that in our tax system, as elsewhere, we are ready to meet those challenges. Thank you very much.
Okay, I think we have just a few minutes for questions. So what I'll do is I'll take a group of three, see how long David takes to answer them, and then we'll see if there's chance for another. So would anybody like to kick the questions off? Yep.
I was wondering,
Identify yourself.
Alec Rogers with the Xerox Corporation. I was wondering if you could tell us a little bit about what you did to prepare the public for the changes you had in mind, in particular with regards to tax policy. Was it part of the manifesto? Was it part of the debate during the election? Anything you can tell us about the steps that you took to prepare the public for your reforms in regards to taxes? Thank you.
Right. Are there any other questions we can just pick up before? No. Oh, yeah. Jane.
Yes, you must have gotten some data by now as to the extent to which more income was repatriated when you moved to a territorial tax. Can you tell me if that was large or small, or where we might be able to get some data on that? Because that's a very big issue here when we're talking about going territorial repatriations.
Sorry, Jane, could you just identify yourself for David?
Oh, I'm Jane Gravel from the Congressional Research Service.
Thank you.
I'm the Ways and Means side of your...
And maybe one more. Yeah.
Satara Sami from Pharma. In reference to the patent box, is there any requirement that the R&D activity that leads to the development of the patented product take place in the UK?
Fine. Let me quickly run through those. First of all, on to the extent we prepared the public for it, it would be fair to say that much of this is a sort of specialist interest, and some of the irritatingly, I know I keep putting it in my election literature, but nobody reads that. But it would be right to say that we did look at this in opposition for quite some time, and former Chancellor of the Exchequer, Geoffrey Howe, Lord Howe, published a report on the tax policy making process and about publishing things in advance and so on, and we endorsed that in opposition. So it was lined up. As to the reforms as such and substance, we didn't go into the last election with a specific pledge to reduce corporation tax rates. We very much made noises about wanting to be more competitive, but on this particular area, we weren't particularly specific. It was a question of seeing what we felt we could afford. And that's how it sort of flowed from there. But in terms of sort of sending out a message of greater certainty and stability in the tax system, that was a point that we were making for some time. And when I did this job in opposition, was making it every opportunity. As far as some of the data is concerned, the CFC regime comes in from next April. So that element of the sort of move towards territoriality, we will see the impacts thereafter. We moved to the system, and essentially it's going to work for companies from the beginning of next January. So it's too early really to have much data. What we can see is that those businesses that, in 2007, there was a long list of businesses that were moving out their domicile out of the UK. That has certainly stopped, and we're starting to see them coming back, and we know that there are many who are talking to us privately, as well as those who've publicly already announced that they're coming over. As far as the patent box is concerned, that it relates to profits where the patent is in the UK, not necessarily where the R&D is done. We've got R&D tax credits to incentivize that, but essentially, each stage of the process when it comes to these innovative products, if you like, whether it's the investment or in R&D, we've strengthened R&D tax credits. When it comes to the profits relating to the patents, then that's dealt with by the patent box. So each way through the process, we are as competitive as possible. And why those particular areas? Because they are the most mobile. Those are the ones that can go elsewhere. That's where the competition is greatest. Businesses can choose where they locate their industries in that area, and we have to compete, because if we don't compete, then it'll be France, Belgium, the Netherlands, Switzerland, the Republic of Ireland. Within Western Europe, it is a very, very competitive field.
I think we probably have to make way for the panel, but I hope you'll all agree with me that the UK is particularly fortunate in having a minister like David in charge of this process, not just interested, but also knowledgeable. So please join me again in thanking David. And if the panel would now like to come up, that would be great.
While the panel is getting settled, I will do some introductory comments. My name is Martin Sullivan. I am the chief economist and contributing editor at Tax Analyst, the nonprofit publisher of Tax Notes magazine. As David Gauke has just described for us, the tax changes adopted in the UK are bold and far-reaching. I think what makes these changes particularly noteworthy is they have not occurred as part of an overall stimulus package like we would do them here in the United States, like we had in 2009. And they were not part of a broad-based tax cut like we had in 2001. No, they were done at the same time that they were raising other taxes and cutting spending as part of their austerity program to reduce and stabilize their public debt. Meanwhile, back in the United States, everybody's talking about cutting corporate tax rates. The Bowles-Simpson plan, the Rivlin-Domenici plan, the Wyden-Coates plan all call for cutting the corporate rate from 35 to the 20s. Likewise, there are plans from the Budget Committee Chairman Paul Ryan, from the Ways and Means Chairman Dave Camp, from Mitt Romney, all want the corporate rate to be 25%. And just in case you think this is just a Republican phenomenon, Mr. President Obama also wants the rate to be reduced to 28%. When it comes to international taxation, although it does not have the same breadth of support as a corporate rate cut, the idea of a territorial system for the United States is getting more and more attention. Exemption of foreign profits from U.S. tax is part of the Bowles-Simpson plan, the Ryan plan, the Romney plan, and the Camp plan. And although it is not an official administration policy, if we can believe what Bob Woodward wrote in his latest book, page 242, during the 2011 debt limit negotiations, the Obama administration was willing to agree to adoption of a territorial system as part of their larger tax reform deficit reduction compromise. That's not official, that's just, let's say, high-powered hearsay. So, should the United States lower its corporate rate and move to a territorial system like the United Kingdom? And if we do, should we and can we cut our rate as low as the UK? And should we adopt the same type of territorial system as the United Kingdom? To answer these questions, we have assembled a world-class panel. Despite their youthful appearance and good looks, they bring a wealth of experience and wisdom that we need to address these issues. Michael Devereaux is Professor of Economics at the University of Oxford and Research Director of the Oxford University Center for Business and Taxation. He is Research Fellow at the Institute for Fiscal Studies, Research Director of the European Tax Policy Forum, and member of the Government Business Forum of Tax and Competitiveness, chaired by David Gauke. The Honorable Richard Gephardt was the Majority Leader of the U.S. House of Representatives from 1989 to 1995 and Minority Leader from 1995 to 2003. He is now President and CEO of the Gephardt Group Government Affairs. Dick's accomplishments during his brilliant career are too numerous to list here, but I want to just mention two that are relevant to the topic today. First, there is this path-breaking tax reform legislation that laid the foundation for the 1986 Tax Reform Act. And less well-known, but probably just as relevant to our current situation, is the pivotal role he played in the long and grueling negotiations during the budget summit of 1990. I hope he's recovered from those. Thank you so much for that. Jim Hines comes from the University of Michigan, where he wears many hats. In the economics department, he is the Richard Musgrave Professor of Economics. At the law school, he's the Hart Wright Professor of Law. And at the business school, he is the Research Director of the Office of Tax Policy Research. In his spare time, he's a Research Associate at the National Bureau of Economic Research, Research Director of the International Tax Policy Forum, and co-editor of the Journal of Public Economics. And finally, Stephen Shea is Professor of Practice at Harvard Law School. Before joining the Harvard Law School faculty, Steve was Deputy Assistant Secretary for International Tax at Treasury. And prior to his appointment to Treasury in 2009, he was a tax partner for 22 years at the law firm of Ropes & Gray. And just last week, Steve testified before the Senate Permanent Subcommittee on Investigations on the topic of international taxation. Okay, here's how we shall proceed. What I'd like to do is just go through a few rounds of questions, 2, possibly 3, depending on how much time we have. And then we want to get questions from the floor as soon as possible, because I know we have a very well-informed audience. So let's start, please, with Michael as our guest from the UK. David talked about political hit, I think was the term he used. And he mentioned how to pay for, there were offsetting tax increases at the same time a pro-business policy was being instituted. What were some of those political hits? What were some of the, what we call them in the United States are revenue raisers. What were some of those revenue raisers that were part of the tax increase that simultaneously occurred with the other tax changes?
Okay, well, thanks. Before I can answer that, can I just kind of add my thanks and tribute to David, who's done an excellent job since he's kind of come into office, with the officials Mike Williams and Judith Notto here. I mean, actually, the process of tax policy making in the UK has been transformed and is actually now extremely good. After the election, the government set out its roadmap for corporate tax reform. It was all written down where they were going to go, and pretty much it's gone in that direction with considerable consultation with business and others along the way. And I think that process has been extremely good, and I think it's generated pretty good policy on the whole. So broadly, I've been I'm supportive of it, and I kind of want to say that up front because I want to pick on kind of little bits of it to argue about. And in the interest of balance, I think I should also say that David's predecessor, Stephen Timms from the Labour Party, he also did a good job, and it was mainly most of the international stuff that happened and moving to territoriality actually took place even before this government came into power. So I think we've been quite fortunate in our leaders over the last few years. Coming to the question. Clearly this costs money to cut the rate of corporation tax, and the government did this at a time when we had a massive deficit, and it was at the same time cutting spending quite dramatically, raising other taxes, VAT as David mentioned. There was one other factor. So part of the story is despite the fact that the government was trying to save money everywhere, it felt that this was the most important thing to do in terms of kind of growth and investment. I think an interesting thing to focus on, which I quite like to mention, is there was a cut in the rate. Back in 2010, when this package was announced, there's also a cut in allowances. So the main kind of type of reform at the time was very much a kind of rate-cutting, base broadening reform of the kind that we've seen in many countries. I think since then, actually, the rate's been cut even further. So the cost of cutting the rate was higher than the base broadening brought in, but that was still the kind of nature of what happened. And the cost of that was kind of, the total cost is relatively small compared with the kind of VAT increase, for example. It's much smaller than the VAT increase. The VAT we raised by 2 percentage points, but it's a very large base, so you raise a lot of money from that. But I think an interesting thing about this, the revenue, the rate reducing base broadening reform is that, if we took that to extremes, it's a revenue neutral reform. On the whole, it's going to affect business in different ways, but it can't be uniformly good for everybody. And the effect of this, I think, was, we reduced capital allowances for business, but we reduced the rate as well. And that's going to have different effects on different kinds of business. So, those businesses which, have high tangible investment, old-fashioned fixed investment in manufacturing are going to lose relative to those which, invest more in intangibles. Companies which are more profitable are going to benefit more from the reduction in rate. So we might expect to attract more of those. We would expect to attract rather less of the kind of marginal investments from other countries. And a reduction in the rate should benefit profit shifting issues. There should be less incentives for companies to shift their profits abroad. So with my hat on as director of the Centre for Business Tax in Oxford, we took this idea that we should have the most competitive tax system in the G20, literally, and we then went and looked at the data in the G20 and also the OECD and tried to figure out how well we were. And David's already kind of given some statistics on this. I think the main thing that we contributed there was, we're not just looking at the statutory rate, but we also, take into account the tax base and generate some measures of effective tax rate. And now I think it's fair to say, certainly measured by capital allowances, we're actually rather ungenerous in terms of capital allowances. In fact, we did on our measure across the whole of the G20 countries and the OECD countries, there's only one other country which was less generous than the UK. So it's not so. The low rate is good for business. The lower allowances are not so good. I'm just kind of on. If I got kind of 1 more minute, or have I gone too long already? Just on the kind of motivation and the kind of the public nature of the debate. There's been a lot of debate in the UK recently about tax and corporation tax, but it's all been of the form, are large businesses paying the amount of tax they should be paying, or are they avoiding it through different ways? There's actually there's been very little comment, there's been very little adverse comment, I think, on actually the kind of structural reforms which the government's introduced. I'll stop there.
I want to go to the U.S. now. I want to ask Dick, as a former longtime Ways and Means Committee member, you know that to throw numbers around and talk about lower rates is easy to do, but when it comes to actually paying for those lower rates and in real legislation, that's a little more difficult. And we've just heard a little bit about how depreciation allowances had to be cut in the UK. Can you describe to us or foresee any way that Congress will find the money to pay for lower corporate tax rates?
Well, it's a really good question, and if we step back from this, I think I'm really impressed with what you did in Britain in trying to drive the debate to the question of what are we trying to do, because I think that's really important in setting this debate. When we did this in 1986, our goal was tax reform, and for the sake of tax reform. And the watchwords were make it fair and simple. And that was fine. And we did it without raising it. From the outset, we said it has to be revenue neutral. So that kind of defined that debate. And frankly, as I look back on it, I don't know that was the best way to cast it. And I certainly don't think it can be done that way now, because of the severe economic problems that we and the rest of the world face. So as I'm sitting here listening to this, it occurs to me that I think we would be far better off if we could set this debate about taxes as a subpart of the overall goal of getting our economy to function at a higher level. And if we could do that politically, if the leaders could do that, I think it would make for a much healthier debate and perhaps a better outcome on taxes and on the other questions. And of course, I find it hard to believe that we could do tax reform in 2013 or 14 without dealing with the budget questions, which are severe, as we all know. And so I think that again puts tax reform in a very different context. And again, if we can all be focusing on how do we achieve more growth, more economic success, that would help us on both fronts, I think, what to cut and how to change the tax system. And the last thing I'd say is that when you get to taxes, you know, in 86, and I'm sure now you will be constrained to get into how much should individuals pay and how much should corporations pay. And again, that will be affected, I think, positively from everybody's viewpoint. If the overall goal is economic growth, again, I go back to that motivation. But that will always be a question, and in our political dialogue, we've already had a lot of debate about, you know, fairness and who should pay and how much they should pay and what should corporations pay and what should individuals pay. In 86, just to remind you, we kind of took more money from corporations so that we could get the rates down for individuals. Because as you all well know, when you get into tax reform, you're taking tax breaks from somebody and giving lower tax rates to everybody. And that's the basic transaction, and it's a very politically tough transaction. And so I'll end with kind of how hard 86 was to do. And we were not raising any more revenue. We were just moving some taxes from individuals to corporations, and that was one part of the transaction, but we were being revenue neutral. And even with those guidelines, this was very hard to do. So doing it now within the context of a budget that probably will need some revenue, this becomes triply hard. And again, if it can't be put in the context of economic growth and success, I'm not sure it can be done.
Well, on that, the revenue-raising tax reform is something that would be, as you say, would be extremely difficult. And then I think the other thing that most of us who don't have gray hair recall is that the 86 Act did redistribute the tax burden to corporations. And now, for competitiveness reasons, we may be talking about reducing the corporate tax. Therefore, we would be shifting the burden back to individuals, not not something you want to take back to your home district.
Not a day at the beach.
Even a British. Steve, what do you think about the corporate tax rate? Do you think it needs to be reduced, and if we does, how would we pay for that type of reduction?
Let me skip the first question in terms of whether I think it should be reduced. I want to build on what Mr. Gephardt was just saying. And I was at Treasury from 82 to 87 in my first career, so first before going to Ropes and Gray, so I also lived through part of that. The biggest change in our business tax environment since 1986, two big changes. One is that at that time we had a very defined corporate sector, and we had individual taxation, and we had a relatively small pass-through sector. Today, latest report I saw was that 70% of our business income is earned by pass-throughs. Which is a little higher, but it's 60 to 70%. It's more than half of our business income. And that sets the context for the discussion of a reduction in corporate rates. I don't think in the current environment where our two biggest immediate issues, which pertain to growth, are how do we get more people employed in this country, and how do we deal with our structural deficit problem, at least over the long term, in a way that is credible. Those are our two most immediate problems. And so one question you need to ask at the outset is, where does reducing the corporate rate come in accomplishing that if, as a practical political matter, you cannot shift effective tax burden from the corporate sector that's left to individuals? And just to break that apart a little bit. And the other question is, even if we could, is it worth it? I mean, are we getting the incentives? Is that a key to growth? Is the growth outcome worth it? So if you look at the largest potential base broadeners that could pay for a lower corporate rate through broadening a base, the biggest single one by several multiples is accelerated depreciation. So we would as well, even within the corporate base, have to slow down depreciation, reduce incentives for investment in tangible plant and equipment as a price to pay for a lower rate that would benefit all corporations, presumably. That also affects all the pass-throughs. So if you do that to pay for your lower corporate rate, you have to deal with the increase in effective tax rate on the pass-through sector that has not had a rate reduction. Or do you give them a rate reduction? If you give them a rate reduction, we would, for the first time outside of the capital gains area, have a different rate of tax on individual business income from individual income from other sources. We've not done that. If we don't do that, where else can we get the lower rate from? Well, I think we can do it from deficit financing, but I don't think that's feasible at this point. Or I think it's politically implausible. And whether that's good policy is highly questionable to me. And if we rule out cross-subsidy from pass-throughs, and the other cross-subsidy is just as we were talking about, from individuals on other personal income, higher effective rates on individuals and other personal income. The last one we haven't talked about, which came up by Secretary Gauke, is that the right term, I hope?
I'll answer to anything. But,
is VAT. Well, we don't have a federal VAT, but a new tax instrument, whether it's a VAT, a carbon tax, or some other source. I think people in this town generally view that as politically implausible. So if you do limit yourself to base broadeners and you restrict it to the base broadeners that affect the corporations, I don't think realistically, if you take R&D off the table, you probably can't get below 31%. And I'm not a revenue estimator, but as a ballpark matter, you're talking a couple of points, and most of that comes from accelerated depreciation. So then that comes back to the question of, is that a good idea? And for that, I think it's good for me to turn to the economists and maybe ask them to help understand.
Jim, you are an economist. UK is going to have a 22% rate in 2014. Do you think that's realistic, or do you think it's a good idea for us?
You're asking whether it's politically realistic, so you turn to an economist for the answer? Yeah, sure. There seems to be widespread agreement that it would be beneficial for the economy if we had a lower corporate tax rate, assuming that we could address the other issues like the budget and everything else at the same time. And that is certainly consistent with economic theory, and it's consistent with the evidence that we have about how economies perform, that you do get economic benefits from a lower corporate tax rate because you have fewer of the distortions that that are associated with the corporate tax that way. Not only that, but every little bit helps. That is, you get benefits from going from the current statutory rate of 35%, and if you go to 30%, you get a certain amount of benefits, and if you go from 30 to 25, you continue to get more benefits. It's not like they stop, magically just because you meet the OECD average or anything. It's continues to be beneficial. the difficulty is, how do you pay for this tax reduction? And there is this funny situation we've gotten ourselves into, which is we think of the status quo as the default, because it sort of is the default if you don't enact new legislation. But if you were starting from scratch and you said, okay, we've got the US economy and we need to raise a certain amount of revenue, would you, as part of that revenue, say, oh, let's have a 35% corporate tax rate in today's world? I doubt very much that that would be what you would draft starting from scratch, because it would be way high compared to other countries. And frankly, we've never been able to offer a very good justification for why you want a high corporate tax rate, no matter what other countries do. Because it's not a very good way to raise, there are much more effective ways to raise revenue that create fewer economic distortions. And it's just sort of hard to understand why you have this. Some people, defend the corporate tax on the grounds that it's a progressive tax because the belief is that the costs fall on wealthier parts of society. But if tax progressivity is what you want, you have an individual income tax that you can design to be progressive. So what do what would be realistic? What do we do given that we have this situation where we kind of take the status quo as the default and move from there? And I must say, I very much like the way Congressman Gephardt was talking about this, in that I think it depends on what else you are doing at the same time in your reform. So, for example, if the country, I think there's widespread acknowledgement that we have a serious jobs problem in the United States, that things have to be done about not just unemployment, but also stagnating and in many cases declining wages. And if corporate tax reform is crafted and understood to be part of a job creation package that isn't just corporate tax reform, but is a lot of other measures too, then it really does make sense as part of that package. If all you do is not change the base but lower the statutory rate, of course that is going to lose you some revenue, and you would need to make it up some other way, no doubt about it. But a lot of the measures that people talk about with job creation, including education and training and lots of things that are needed and are effective, the problem is that they don't, they're a lot more effective if you've got a vibrant business sector at the same time that is expanding, plants and expanding employment and not laying people off. And you're more apt to get that if business is, is thriving, and for that, a healthy tax environment is needed. So I guess if you want a number, in 1986, with many, many changes on the table, we went from 46% to 34%. In the present environment, a similar kind of reduction would take us to something like 25%. In 1986, we had a lot of base broadeners that went with that statutory reduction. And the base broadeners, many of them are pretty unappetizing in the present environment. And frankly, we don't have as many of the gimmicks going on now as we did in the roaring 80s, that you could then take away as base broadeners. So a realistic, attractive statutory corporate tax reduction probably at the end of the day is going to, on the corporate side only now, look like a money loser. But if you combine it with a big package of things, it can be a very attractive package.
And Jim, do you want to venture what those more economically efficient ways of raising revenue might be?
Well, value-added tax for sure, but that's. I think there's a lot of agreement on that, but not on Capitol Hill.
You don't. Well, as we see, getting the corporate rate to 25% might be a little more difficult than some folks on Capitol Hill are telling us. I want to move on now, while we have a little more time, to talk about the key issue of international tax reform. And Michael and David, since you're here as well, please chime in. As I understand it, reading the archives of newspapers, it's been about a 5-year journey for the UK to go to a territorial system and get the CFC rules in place. In fact, it was the Labour government that made the first proposal for a territorial system in 2007. Just for the benefit of folks who are not as familiar, maybe describe a little bit of that long journey that got you to where you are today.
Sure, it's been going on for at least 5 years. I'd say it's probably quite a bit longer than that. And I think the origins are actually in something which the UK has, which the US doesn't, which is kind of membership of the European Union. Because one of the drivers of the change, this is viewed from the outside. I should say Mike Williams is kind of in the Treasury at the time, could probably say more about this. But one of the drivers at the time was there are restrictions on what UK law can be, and one of the restrictions is you can't discriminate against activity taking place in France compared with the UK. And arguably, our old credit system was doing that. So there were cases before the European Court of Justice which were testing that. Essentially, if a UK subsidiary paid a dividend to a UK parent, that was not taxable. But if a French, well, actually not a French, but a European subsidiary paid it to a UK subsidiary, that was in principle taxable, and that was the issue. I think in the end, actually, the court ruled that was okay for foreign direct investment. But I think by that time, we'd actually moved quite a long way down this road. And I think there's another kind of difference between the UK and the US here, which I think is relevant as well, which is the extent to which UK business is actually owned by UK individuals. And I think that makes a difference to whether you're actually thinking about taxing the UK company with lots of activities abroad. If all that's in the UK is headquarters and the shareholders are somewhere else, the activities are somewhere else, then the rationale for having a credit system and taxing it when it all comes back is much weaker. And that was certainly part of what was in my mind. I don't know how far it was in the government's mind at the time. I think another issue at the time was, how much revenue is at stake here. And I think there are two aspects of that. One, the actual amount of revenue was raised from taxing foreign source dividends coming back to the UK was not that great. I think the much bigger issue was, by taking that away, would that open the stable gate, if you like, to more tax avoidance opportunities? Would it be easier for British companies to put their profit somewhere else and then bring it back tax-free? Before, if they brought it back, they would be taxed. Now they wouldn't be. And that's really where the CFC regime came in, and there were proposals by the Labour government in 2007, which are a bit draconian probably, which would, they got abandoned. At the time, it was certainly the case that the government wanted to have a kind of new CFC regime in place at the time the territorial system was introduced, and that was not possible in the end. When the territorial system was introduced, we did introduce some restrictions on interest relief, the kind of the worldwide debt cap, but then the negotiations and discussion about what an appropriate CFC regime would be has kind of taken place ever since then, and as David says, it's still not introduced. It's being introduced next year, but the features of it are set up. I think. David, do you want to?
Well, yeah, just to follow up, and yes, Mike, you're right. With the legislation is passed, and there has been a consensus on this, and the process did begin, I suppose, 2007. There's a question about getting the balance between protecting the tax base and also having as competitive an arrangement as possible. The 2007 proposals did go down badly, and there were a number of entities that re-domiciled at that point. And then it was put on pause. When we came into office in 2010, we were very keen to address this particular issue. It was the one thing that we were hearing all the time about UK competitiveness. And it's good for an economy, it seems to us, to have head offices located. It's not just the simple, a certain number of jobs come over with it, and sometimes it can be quite small directly. But in terms of having decision makers in the UK, that has got to be good for us. We've got professional support industries are very, very strong, accountants, lawyers, etc., etc. That's all good for the UK, and the general reputation of the UK as a place in which you can do business benefits from having that reform. As far as cost, and perhaps this comes back to one of the earlier questions, I think we estimated that the cost of the CFC reforms is likely to be around about £1 billion. There's an interesting sort of argument that goes on. Businesses tell us that we overestimate the cost. It'll be far less than that when you take into account the dynamic effect.
We don't have any of that in this country.
No, I'm sure you don't. There's a bit of a debate over that. But it was, I wouldn't underestimate how damaging it was for morale for UK business when you sort of see one business after another upping sticks, and equally how encouraging it is when people are saying, we want to locate our head office in the UK. And Yeah, Mike's right. It does all have to be put in the context of where the UK is, our neighbours, the competition in this field. It's a very competitive environment in Western Europe. And the fact is that the ownership structure of businesses, if you look at businesses listed on the stock exchange, very often they're foreign owned. And if you want decisions to be made, you want head offices to be made in the UK, then the idea of trying to tax those companies on profits made elsewhere in the world is just something that means they're not going to be here, or they're not going to be in the UK, and that's not what we want.
David and Michael, just for the audience here, would it be fair to say that the 2007 labor proposal, which, as you say, went over like a lead balloon? No, it was a territorial system, but business didn't like it, and I think it's one thing for non-specialists to realize is not every territorial system is a pro-business change or a revenue cut, a tax cut. But perhaps after you took power in 2010, a little more willingness to give a little revenue on that made it much more popular and palatable to business. Is that a fair?
Yeah, I think that is fair. We were prepared to show more flexibility. That's not to say that had Labour been re-elected that they wouldn't have done. I think the decision that we made was obviously I think it's the right one, but I think any sensible government in those circumstances would have seen that we had to address the issue, and the only way to address it was to show greater flexibility. And yes, that did have a revenue cost, but in the great scheme of things, it's not something that has bust the bank.
Dick, as you know, in 1986, with the international reform then, we were tightening on multinational businesses. We were raising revenue from offshore profits. Now we may be talking about, again, moving in the exact opposite direction. Do you think the next tax reform is going to go in that direction, actually reduce taxes on multinationals? Is that something politically feasible, or even if it's economically necessary?
Well, again, I think all of this will be affected by how the whole debate is cast. And again, if it can be put in terms of growth and success and competitiveness, it may take a different direction. So I think that's extremely important politically. If you just look at the politics of this, if we're in a budget context, which we're likely to be if it's done in the next year, and if the number one goal of the corporate community and others who are worried about growth is getting the rate down as low as possible, I'm kind of skeptical that territorial system can be added to that at the same time, whether that's the right thing to do or not. But again, I think the debate will be affected by how much the leaders in the country that are leading this debate can focus people on the goal. Mm-hmm. And if the goal is growth and competitiveness, and cogent arguments can be made that the rate and a territorial system are essential to reaching those goals, then there's a chance that it could move back in that direction.
Well, that's a perfect lead into my next question. Jim, what is the case for moving to a territorial system? Is it it's going to be very difficult to do. Why should we do it?
Because doing the right thing is worth it, even if it's hard to do. The argument in favor of having a territorial system only taxing profits that are earned in your country is that it makes your businesses more productive, and it leads to a more efficient allocation of the ownership of productive assets. The somewhat less prosaic but maybe more intuitive case is that every other major capital exporting country in the world has some form of a territorial system, which the United States does not. And my guess is that, ultimately, maybe, preferably sooner, but ultimately we will wind up with a territorial system, in part because we're the only country kind of sticking out compared to everybody else. I must say, it would be nice for the United States to get ahead of the game sometime, instead of seeming to tail after the rest of the world, as the rest of the world lowers its rates, corporate rates, and ours is stuck at a high level, and as the rest of the world, many countries long ago adopted territorial tax systems. I mean, the UK obviously had a very recent reform, Japan as well, but many other of the countries with which we compete did so earlier. Anyway, the idea is that it makes firms more productive. What is the advantage of making firms more productive? The advantage of that is it makes your whole economy more productive, which mostly redounds to the benefit of American workers. That's the theory. That making business more productive doesn't help business as long as business is in a competitive environment. The more competitive that environment is, the more they compete away from themselves the benefits of the additional productivity. It really ultimately is mostly to the benefit of workers because it raises labor demand. Labor demand is a function of how productive labor is. And businesses have to be productive for labor to be productive in a modern economy. So the notion is it creates more jobs and higher wages if you have more efficient allocation of ownership, including with a territorial system.
Jim, reflecting back to Mr. Gephardt's comments, wouldn't you have to balance that if territoriality costs revenue? You have to balance that against some other pro-competitiveness things like reducing the corporate rate. So how do we balance if that were a choice? I hate to give you that choice, but that's the real world. How do we balance that?
That's a fair question. Look, I completely agree. We need to be in fiscal balance, and we're not. So, whatever we do on territoriality, we've got to raise revenue or cut spending. Probably a combination. So, but if it came down to strictly on efficiency terms now, would you be better off having to raise the corporate rate, some small piece, in order to pay for territorial? Does that come out ahead? Yes, it does.
Steve, let me ask you. What do you think about the priority that in tax reform that territoriality should get?
Well, I think to put this in context, it's helpful to go back to the Secretary's remarks at the outset, because one of the issues is other countries have done it. What about the United States? And I was struck by a number of things that were said about the UK. It is less than 1/6 the size of the American economy. It is a much more open economy. The traded sector, imports and exports are over 40% in the UK. In the US, it's roughly 20%. What I learned, and I had looked that data up in advance, but what I really took away from the earlier remarks, which I thought was very interesting, was how much pressure the UK was under from its EU neighbors. I was aware of the legal pressure of the EU treaty, putting pressure on having to change the system. But what I learned today, and particularly in relation to the patent box, is how much pressure. It's as though California is competing against Texas, and it is, and states respond. And within the EU, you have countries also competing on the same basis. I'm also struck at the extent to which your comments have referred to Western Europe. But all of Europe combined is the only larger economic unit than the United States. Any one country in Europe, the UK is less than 1/6. The largest company in Europe is roughly double the UK, which is Germany. And this is just GDP terms. So the question is, are the drivers that are in the UK, are they, and more importantly, should they be the same as here? We're not in the same position. So that's the entry to point. So what's the case against territorial? In a budget-constrained environment, which is my beginning and overwhelmingly driving context, because if you're a policymaker, you don't answer the questions in the abstract. You are going to have to pay for a rate cut. You're going to have to pay for territorial. And territorial will cost money unless you put on a lot of bells and whistles and anti-abuse things. And to get it to be not a revenue loser, the first question is, will the business community support it? There's some suggestion in my judgment that they might not do what's necessary. And we'll come back to that maybe in another go-round. So what are the issues I'm concerned about with territorial? I guess if I add them up, there are 5, but the first 3 are revenue. And it all goes to transfer pricing. The reference was made to my testimony last week. I was shown some data. Just as an example, Microsoft's 2011, 28 billion of EBT, 15 billion apparently, is from the data I saw, was earned in Puerto Rico, Singapore, Ireland. I don't know how much was earned in the UK, but I'd be interested. I wasn't given that information. So transfer pricing is an issue we have not come to terms with, and it's an issue that we need to address. And frankly, I'm very interested in watching over the next couple of years what the experience will be from our European friends who put this experiment on. And finally, the evidence of national benefit. The question is, if the President's Advisory Panel that gave its report in the summer of 2010 looked at this issue, did a literature review, and came to the conclusion that there just was not evidence that tipped one way or the other as to whether international operations subsidizing them or benefiting them, if you don't like the word subsidy, was beneficial for the national economy, for the jobs and economic activity in the United States, or not. And I think the more nuanced view is certainly for some companies it is beneficial, in the sense of, for some companies, being able to invest abroad helps them build their U.S. businesses, and for other companies it's not. But we operate a system. We have to, and before we go in this direction and we expose a real erosion to our domestic tax base, which will happen, we need, I think, to be, for me, I would need more evidence, more clear evidence that there's a benefit to the economic activity in the United States, to jobs and growth in the United States. Why do I say it can get worse? A lot of people say, well, we already have transfer pricing problems, it can't get worse. This is another point of difference with the United Kingdom. Prior to moving to a territorial system, the UK actually had a virtual territorial system because their foreign subsidiaries could lend back to the UK parent their profits without having an income inclusion. They did not have a rule that we have in our rules that causes that loan itself to be treated as though it's an actual distribution. They actually made money, increased revenue, by moving to territorial in significant part, or at least their estimates were that they would, because they were cutting off this upstream loan phenomenon, which created an interest deduction in the United Kingdom, and the income in the foreign subsidiaries, their then CFC regime, it was avoidable with respect to that income. Even if the income had been taxed, you're basically allowing low tax profits to come back and be used in the domestic economy to the disadvantage of any local competitor that doesn't have the offshore business. That is of great concern to me. So the second issue after revenue for me is, how do we think about competition with local businesses? It's one thing when you're in the EU and you really aren't thinking just local businesses. You're thinking just, it's like Netherlands, France, are more local. I don't think we're in the same position on that issue, and I think we have a much larger domestic economy that isn't cross-border. So we have more of a competitive issue to have to think about. So those are the 3 issues I'd raise: revenue, competition with domestic businesses in the context of the U.S. economy, not the European economy, and the evidence of national benefit.
I think our audience can take away from this that there's obviously debate about the benefits, costs and benefits of a territorial system, but also there are different types of territorial systems. There's actually some territorial systems that raise revenue. And so but when when you follow the political debate, you just hear territoriality without those important details. And I think that's something for all of us to remember. Given that time is short, I'm not going to continue monopolizing the panel. We can open up the floor to questions. Are there any questions from the audience? Sir.
Hi, Tim McDonald, Procter & Gamble. The opening prepared remarks were pretty interesting. If I took notes right, there was a description of the reason for change included a belief that corporate tax burdens labor significantly. I'd like to understand order of magnitude, and that you increased your VAT. And you did make an observation that the necessities are exempted, so perhaps it's less regressive in the UK. And you mentioned kind of a dynamic scoring. So that all leads to kind of discussion about burden. So I'm curious, in the overall package that you put together, you had raisers and cuts. How did you think about the burden of the average person in the UK? Does the average person in the UK have an individual income tax burden at all, like the median income level? And roughly what tax rate is that? Because we have data in the US we could compare it to. And it all builds to the burden on labor. What I really would like you to answer is, do you believe that lower skilled labor, which presumably is lower income, has a disproportionately negative impact on wage suppression and unemployment if you have a high tax rate? Or what's the interdependency of a high corporate tax rate on the hidden burden for labor?
Well, I think on the first of all, on the distributional analysis, what we published at the time of the 2010 general election, and this was the first time that any UK government had done that, was an analysis showing the impact of all the measures that were occurring, looking at all of the 10 deciles. And what the evidence showed, and it does take into account lots of tax and spend measures, was that the burden was greatest on the wealthiest, and it generally ran through declining through. Not entirely the case. The bottom decile, for example, did worse than the second decile. It's quite difficult with the bottom decile when you're doing any kind of welfare reform. You almost inevitably there's going to be an impact there. The point I was making with regard to the burden of corporation tax, and here I would make the point that I think there are differences between what the academics say occurs with the UK and the US, and Mike is certainly better qualified to discuss this than I am, is that because, if you like, capital is so mobile, if we have uncompetitive rates of corporation tax, capital will go elsewhere, and that the real capital is more mobile than labour, and the sort of ultimate losers will be employees of those firms paying corporation tax. Now, where those employees are in the decile, if it's banks, quite a lot of them tend to be at the top decile. It really does depend. It's quite difficult, I think, to run it through and do a detailed distributional analysis. I think the point I would make is a broader one, which is, it is in the interests of all parts of our society that the UK economy is successful, grows, is a place that businesses want to invest in, and where jobs are going to be available. Now that means pursuing pro-growth policies, and in a time of austerity, that means, amongst other things, having a tax system as efficient as possible. We're not a low tax jurisdiction. I mean, when we came in, public spending was around about 50% of GDP, far too high to be sustainable, and we'll bring that down to around about 39% of GDP. But we've got to find a lot of tax to pay for that, and it seems to us, in the conditions that exist for the UK, the idea of trying to squeeze corporates as much as possible when when businesses can invest elsewhere is just not right for our economy and not right for any section of our society.
I just wanted to make one comment that I think ties into this distributional issue, and that is, in preparing for this panel, I was trying to find data on income distribution in the United States and the UK. And the UK is, at least under the traditional look at a Gini index, which I'm not going to try and explain, but it's an index of inequality, is materially less, I'm using a double negative, is more equal in its income distribution than the United States by a considerable measure. So you can argue that some shifting, say to individuals, or well, I'm not going to get into incidents, but you can argue that they have a little bit more room. We have a bigger problem in terms of income inequality than the United Kingdom does by a material measure, just as another constraint.
Michael, do you want to add?
If I can do a brief comment on incidents. I mean, there's lots of people in the room who've worked on incidents and trying to estimate this thing, and it's really hard to do. But actually, the point I wanted to make is actually almost none of those studies have actually really looked at the distributional effects in terms of whether it's the more well-off or the less well-off that pay it. You know, the way that economists have looked at it is it labour or capital that bears the incidence? And we may have some answers to that. What we don't know is is it the rich or the poor that pay it? And I haven't seen any good studies which have even tried to address that.
As we go forward in the United States on tax reform and as we saw with the debate now about the Romney plan, the distributional issues are going to be very large. And then when you merge corporate tax reform in there, well, the Joint Committee on Taxation, I believe, still does not distribute the corporate tax, and that issue might be all rehashed again. John.
So I have a comment on something Steve said about whether we have something to learn from the UK, and then a question for David and Michael. It is true that the U.S. economy is much larger than the UK economy, but it isn't larger than the UK combined with Germany, France, Spain, the Netherlands, the rest of the world, and all of those countries have basically reached a consensus as to the right tax system, and we're competing against all of those countries. And in terms of the openness of our economy, all you have to do is look at the trends. While the UK economy may be more open today than ours, the share of our GDP that's accounted for by cross-border trade is increasing exponentially and will continue to do so. So it is sort of the future of the U.S. economy. My question for David and Michael is what motivated the UK to adopt a territorial system? Because to the point Steve made earlier, UK companies could bring back foreign profits from their CFCs through swamping or loans. Was it to get the cash back to the UK, or was it to keep headquarters of UK companies from leaving the UK? To keep, or was it something else? Why did the UK government adopt a territorial regime?
Well, I think certainly as far as the current government is concerned, the flight of UK headquarters that we saw in 2007 was very alarming. That's why the previous government took their proposal off the table to try to rework it. And at that point, that's when we came into the story, if you like. And I think the attractiveness of the CFC reforms that we've put in place is that we hope and expect to see more businesses locate their headquarters in the UK. So I think that for me is really what's driven it.
Mike, go ahead.
So what we've done in the U.S. is enact a statute that says U.S. companies who are here can't leave, or make it very difficult. Called anti-inversion, except Aon managed to figure out how to get from Chicago to London. So there's some porosity in our provision. But what's happening is in cross-border mergers, we are losing headquarters rapidly. And if you're setting up a new global company today, by and large, we're not getting our fair. The share of Fortune 500 companies that are headquartered in the U.S. has dropped dramatically, even compared to our drop in GDP. So we are losing headquarters. Why is having headquarters important to the UK?
Well, I think the first point is obviously the focus of my remarks is what I think is right for the UK, and others can debate what's right for the US. But from our perspective, so I think having those decision makers in the UK, having the support that goes with that, and very often as I say, the professional support firms also very strong within the UK, and as a sort of clear signal that the UK is a place that is open to business, we think it's significant. And if there are people who are there in London, for example, making big decisions about where they want to locate factories or distribution plants or whatever it might be, the fact that they're kind of in the UK is creating a favourable climate, creating perhaps more opportunities for British people, and all round sends a very clear signal that the UK is open to business, and that is what we're really trying to do. I mean, that's and it's not just within tax. I could talk about some of the stuff we're doing on planning and employment law, and switching spending from current to capital so that our infrastructure is strong. I could go on. We want to pull every lever that we can to demonstrate that the UK is a really good place in which to do business for those companies that can choose where they go. It's a key part of that strategy, because that's the way the world is going as far as we can see, certainly for a country in Western Europe. We want to make that point loud and clear.
Michael, did you want to add something?
Well, just briefly, I agree with David. I just wanted to point out another difference between the UK and the US is again is kind of EU treaty obligations. And I'm not a lawyer, but my understanding is much more difficult for the UK to kind of put in anti-inversion rules of the kind that the US might have. So, I mean, it may be happening in the US anyway through those other routes, but that's quite an important difference, I think.
Steve?
Yeah, I think, but you referred to something earlier as well, which is ownership of UK companies. UK companies are owned much more by non-UK nationals, as you would expect. And we heard earlier from David, so I like the fact that coherence comes out of this. How important the London market, the financial industry was at the time these decisions were being made, and still is in the UK. So they're, in relative terms, those are very powerful. Whereas US companies, I think the last time, and I'm not, are becoming more globally owned, but today still there is very significant what's called home bias in stock ownership. So that's another difference. And coming back both to the EU and to the fact of where the UK was before they went to territorial, as a practical matter, a UK domestic company, a purely domestic business, albeit smaller domestic market, but a purely domestic business, had already had to deal with the fact that their neighbor next door that had an international business could earn lower taxed profits in Ireland and Luxembourg in the EU. They could be brought back to use to fund the business to compete with them, the purely domestic business. Today, under our current law, if an international business is going to go out and compete against a domestic business, if it brings the profits back, it's going to have to pay U.S. corporate tax on them as a dividend, assuming some loopholes are tightened. That came out at the hearing last week, but leaving aside the margin, the structure of the system is that the idea is you can earn those profits abroad. You can compete against your foreign competitor, and you cannot have to pay U.S. tax under the current law. And you can reinvest them to compete against the next competitor, but you can't bring them back into the U.S. marketplace to compete against your domestic competitors who don't have that same advantage. And the question is, do we want to move away from that system? The UK both already had and had to. So that's a difference.
Mm-hmm. Peter?
Steve, they could borrow in the U.S.
subject to the haircut, correct?
Yeah, so, thank you. Peter Merrill, PricewaterhouseCoopers. I was struck at the beginning where the economists on both sides of the Atlantic seem to agree that the corporate tax is one of the most economically growth unfriendly taxes, and that a consumption tax from an economic growth standpoint is more efficient. In the UK, remarkably, the economists were listened to. It doesn't happen so much on this side of the Atlantic, and it seems that actually the current government, the preceding government, followed advice of economists and have systematically been lowering corporate rates and remarkably at the same time raising the VAT rate. A policy combination at a time when there's a gigantic fiscal problem is almost inconceivable in the U.S. And my question actually is really for Mr. Gephardt, which is, can you foresee any political circumstance in which the U.S. could shift the tax burden away from the corporate tax to other types of taxes that are less harmful, unlike in 86?
Yeah.
Well, until a year ago, I would have predicted that that couldn't be done at all, ever. I've been through this debate many, many times in the last 30 years, and I've changed my mind because of the gravity of our fiscal situation and because of the gravity of our economic situation. Now, I'm probably wrong because the opposition to a VAT is strong from the left and the right, as you know, for different reasons. But I think there may be a possibility of a VAT being part of an overall solution to both problems, again, if it can be argued successfully from the viewpoint of economic growth and job creation. That's a key element. I also think that to be successful with that argument, it would be extremely helpful if we could get the corporate community and the labor community in the United States to have some robust conversations about that goal and how this leads us to that goal and come to some agreement so that when the Congress gets into its expected snarl over all this, with whoever's in the next administration, business and labor can come in with some ideas that might unlock the snarl.
Very quickly on the politics of it. One thing I would say from the UK experience was that we did this immediately after an election. It was there was a genuine sense of crisis, I think, in the UK, the sovereign debt market, and so on. The political debate really didn't focus on corporation tax very much. There wasn't a big row about it. The big debate was about the speed of deficit reduction. So VAT, which was a big measure towards deficit reduction, was a big part of it. And to some extent, there hasn't, and Mike touched on this earlier, there hasn't been a big row about the corporation tax reforms. There's been a little bit around the edges, but from a mainstream point of view, it hasn't been, believe me, there are far more controversial things I've had to do as a minister than cutting corporation tax.
But can I add one other element to this? As I've been thinking about this, I also think that it will be important at some point, again, to define together our goals, because if the goal is absolute deficit reduction or balancing the budget by a certain date without question, it puts all of this into a different context. And in my view, if labor and business in this country can come together, again, on a growth agenda, it may be that you don't have to, we don't make the goal balancing the budget by a certain time, but the goal, again, should be deficit reduction as part of reaching for more growth and job creation.
Steve?
I just want to make an observation that just how much difference it makes. There are two more differences between the United States and the UK that come out in this conversation to me. A parliamentary system. We do not have somebody who, as Will said at the very beginning, who's both the Assistant Secretary and the Chairman of the Ways and Means. Boy, would that be something. No, it's a very different system, and I think, quite seriously, that has a major impact. Our system is designed not to make these kinds of bold policy moves, but the roadmap, I think Mr. Gephardt has pointed out. It's hard to see, looking at the numbers over the very long term, an outcome that does not include some increase in consumption tax. And it's hard to see that it doesn't make a lot of sense from an overall perspective. But a couple of observations about that. To do that right takes a considerable amount of planning. It needs to be done also with great discipline, because a bad consumption tax can be every bit as inefficient, and I think even more inefficient than an income tax, with too many exceptions in the wrong place if it's politically riddled to death. So these are all things that take work.
We have time for one last question.
But Marty, I have three. No. Robin Barron with Caterpillar. Actually, on the VAT, Congressman, if you assume that there were a number of businesses that agreed that a consumption tax was needed, especially in the budget environment, how do we actually get labor to participate? We've not had a lot of success with that. Then I do have maybe a couple others or related ones. In Steve's discussion before, he was talking about protecting basically U.S. wholly domestic competitors from big bad U.S. multinationals that make money offshore. I don't see, Steve, anywhere in your description what protects them from all those big bad European and Chinese multinationals that can do exactly what our system prohibits U.S. multinationals from doing. They're totally exposed, and we're seeing this from Anheuser-Busch to Chrysler now being part of Fiat. And lastly, Steve, you mentioned the growth of the PE, or not PEs, but the pass-through income, up to 70%. That's a new number. I thought it was still closer to 60, but it's certainly on that trend line. At what point does the small business, which inevitably is going to be in a pass-through form, individual taxation, and the private equity firms that could pretty much disincorporate all but the very largest U.S. companies, make the corporate income tax an anachronism?
I don't want to. Who would like to start?
Well, I'll let Steve take the hard stuff. I think there is a way to engage a large block of labor, if not all of labor, in that discussion. Labor is obviously and should be very focused now on economic growth and jobs. And they are willing to consider, in my view, a lot of things that in the past they may not have considered. So maybe offline we can talk about it. I think there are various ways to bring that about.
I think that's probably the most exciting thing I've heard today in terms of the potential to have leadership from outside what is a currently ossified governance structure, or crippled through partisan differences. But in response, I do agree that one cannot focus on U.S. multinationals in terms of thinking about the U.S. business tax base without thinking about foreign-controlled multinationals investing in the United States. And we have an equal amount of work to do to address issues of potential advantage for foreign-based multinationals as we do worrying about U.S.-based multinationals. As of now, the differences in terms of numbers in terms of investment is still very substantial. So that has not been as big an issue historically. It's probably increasing to some extent. But I absolutely think it has to be addressed for political reasons as well as substantive reasons. On the pass-through issue, this is another place where integration has never been supported by the business community, as far as I can tell, integrating the corporate and individual tax. That is something that has potential to deal with a range of non-neutralities that at least most of the academics and I think economists probably would like to deal with. But there again, in order to have any potential to go in that direction, there needs to be some leadership from the corporate side. And just as on the VAT, those are two questions that I think are really quite interesting.
Well, we're just about run out of time, but before we go, I'm going to take advantage of my power here at the microphone and ask for a show of hands from our panel on whether they think there is a strong probability that the United States will have tax reform in 2013. Just raise your hand. You don't even have to go on the record. You don't even have to...
You mean legislation or reform?
Reform. Oh, okay. So do you think there'll be tax reform? How about the audience? How many think there will be tax reform in 2013?
Why don't you make it 13, 14?
Well, that's okay. All right, 13, 14. There we go. I'm with you, but not 13. Right. Very good. I want to thank our panel and help me thank them with a big round of applause.